Good evening from Washington. I'm Larry O'Connor. The Silicon Valley Bank collapsed over the weekend, leaving a lot of people wondering, is this the beginning of a larger trend under the Biden economy? And how much of the Biden policies actually contributed to this failure? And where were the regulators that work, by the way, for the aforementioned Joe Biden in the executive branch? What's going on? What should we do about it? How bad is it? And how did this bank fail in the first place? I don't know. But we've got E.J. Antoni. He's the research fellow and regional economics person at Heritage Foundation, and he's going to mansplain it to us. E.J., mansplain this. What happened? You got 30 seconds.
Larry, it'd be my pleasure. So basically what happened here was a situation that never even would have been possible had the Federal Reserve not kept interest rates so low for so long. But because they did that, they created a situation in which this failure and many other failures became possible. And what did that look like? I mean, essentially, it's the fact that this bank was reliant upon those low interest rates, and they knowingly accepted too much risk in the form of interest rate risk. And as a consequence of that, as soon as rates began to rise, which they eventually had to do, it doomed this bank. And now, instead of letting the people who took those risks bear the consequences, the federal government is intervening yet again to bail those people out at taxpayer expense.
Yeah, I want to get into that bailout stuff in a minute, but just to clarify this, most banks, don't they have sort of a diversity of assets that they're holding on to, whether it's some of these Treasury-related assets linked to the interest rates versus maybe some companies that they've done venture capital or investments in, there's maybe some real estate, so that if one thing crashes, they're protected across with the other things.
Larry, that's a great point. So what this bank did was essentially it was dependent upon low interest rates, both in terms of its depositors, but also in terms of where it put its money. So its depositors, its clientele was primarily institutions which are dependent upon low interest rates, venture capitalists, tech firms, especially small tech startups. And so as soon as rates began to rise, all of its clients, all of its depositors needed their money and fast.
I see.
At the same time, where did it put its money? Where did it invest? In bonds, which were at an incredibly low interest rate. And as soon as rates began to rise, the value of those bonds decreased.
So the president earlier today made his statement. He said that anybody who's someone who had their money in this bank, he wants their deposits to be insured. Now, the FDIC insurance goes up to, what, $250,000, right? So, which that's part of the deal. FDIC, it was started under Roosevelt, if I remember right. Well, not personally remember, but remember studying. And it was to avoid consumers being, left high and dry. But first of all, the president said that people who did not qualify for FDIC insurance, they'll also have their deposits covered. How does that work? And how is that not a bailout?
It is a bailout, and the fact that the Federal Reserve and others are saying that this is not going to cost taxpayers, I mean, that is laughable. It doesn't even pass the smell test. We are making good on these people's losses. That, by definition, is going to be a cost. And it's amazing that all of this happened virtually overnight. There was no executive action. There was certainly not an act by Congress to authorize this. This is an example of gross federal overreach, where we are guaranteeing the deposits of millionaires and billionaires who frankly took risks that they shouldn't have. And again, if you are going to take the risks, then you should be willing to bear the consequences when those risks materialize and when there's this kind of fallout.
Yeah.
But what we saw over the weekend was you had millionaires out there taking to Twitter and other places to rile people up and to say, if we don't get a bailout this weekend, there's going to be a run on every bank Monday morning. Right. And the federal government caved to the terrorists.
It's basically like they were agitating for a run on the banks just to sort of scare the Treasury Department into this. But I don't understand, if you've got deposits that aren't insured, that means it's more than $250,000. So you're hardly just some mom and pop who put their savings in the bank, right? I mean, that's a pretty big bank account, number one. Number two, everybody knows, I would think, especially if you've got that kind of money, that if you go over $250,000, you're exposed. So how hard is it, if you want to keep cash like that, to just have several accounts in different banks up to the FDIC covered amount? It seems like anyone who was exposed this way did so because of their own folly.
Larry, that's exactly right. Those are all great points. And many people who have that kind of money do exactly that. They spread it out among different accounts to ensure that it is all covered. And just to point out the fact that the management at the bank knew of these risks, they actually had financial instruments which would protect against losses from interest rate risk, and they chose to sell all of those off.
Wow.
In other words, they leveraged themselves up even more.
So, I mean, pardon me for being cynical, but I'm here in Washington, D.C., EJ, and politics runs this town. This is Silicon Valley Bank. A lot of the people who are exposed here are people who work in or even are titans in the high-tech, big-tech industry. They are notoriously supporters of this president and his political party. Do you think maybe that's part of the equation here?
Well, I certainly think that if this had been East Palestine Bank, it would not have gotten a bailout. We would have just let this thing fall and no one would have said a word.
Just like the people of East Palestine, and that is an important takeaway here too. Billions of Biden bucks there to help out Silicon Valley, but still nothing for East Palestine. There was another bank, this one out of New York, I believe, Signature Bank. What can you tell me about this one? I've read that cryptocurrency was a big part of the balance sheet here.
Yeah, again, this is a similar situation where you had an institution that was hyper dependent upon low interest rates. And as that environment went away, so did all of the reasons why anyone should have confidence in this financial institution. And as that happened, and as depositors needed money and they began to withdraw funds, it became very clear that the bank did not have enough funds to meet all of depositors' needs. And at that point, the federal regulators stepped in and shut it down.
And EJ, I think it's important to point out what you said was the crux of all of this was artificially low interest rates and then precipitously climbing at a very fast rate interest rates. That's all directly related to the borrowing and spending policies of this administration, aren't they?
100%. Had the government not spent, borrowed, and printed trillions upon trillions of dollars for the last several years, then we would not even be in this situation. Yeah. But the fact that the Fed kept rates too low for too long meant that they had to slam on the brakes. They had to raise rates hard and fast to try to get inflation under control. So first they stomped on the gas, then they stomped on the brake, and now you have a lot of people going through the windshield.
Finally, where were the regulators? Is it naive to think that certain things like this would show up on a balance sheet if people are looking at this on a regular basis and they say, guys, you're kind of exposed here?
Oh, absolutely. And unfortunately, this is just another example of regulators being asleep at the switch, because you had a bank that had a lot of assets on its books, which technically were still good. But in the current environment, you have to take into account, for example, today's interest rates. And once you start factoring those different things in, you realize that these assets are not at all worth what the bank claims they are worth. And so had regulators done anything more than just a passing glance at this bank's books, they would have seen the risks.
That said, it's Washington, EJ. We only have about 20 seconds left, but you hear people today calling for renewed regulations. There should be more regulations. Trump rolled back regulations. Is it new regulations, or is it just we need competent people keeping account of the current regulations?
No, we need competency. And in regards to the Trump rollback, that was actually a bipartisan move in 2018, and it would not have affected this bank at all because it had to do with systemic risk and not the individual risk of this particular bank.
Facts and not politics. That's why we like EJ Antoni from Heritage Foundation. Thank you, sir. There's more to come on O'Connor tonight.